Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. 1 p.m. on the East Coast. That makes it 10 a.m. on the West Coast. I always have problems with that, Carter. Guy Adami, Carter Worth. Dan is out on the West Coast. Amanda just told me, I think Jacob said it as well, he's going to see Pearl Jam again. You get to the point where being a fan is borderline being sort of creepy, and I think he's sort of on the precipice of that, Carter. That's just me. Thoughts before we get into it?
Well, first on that time zone thing, yeah, there are people who live in towns where you go 100 feet one way, and so you got to have two watches. You get,
which is strange.
That's real strange. Anyway, yeah. It's all good. Still,
speaking of strange,
yeah.
Today is a strange day, and we're going to get at. You know what? Throw the rundown up, Amanda, because why not? I mean, people want to see what we're talking about. The NVIDIA halo effect is alive and well. Higher or lower for yields? I think the market's trying to figure that out. Clearly, we are. Chart check on financials, which have had a good run up until Jamie Dimon's comments the other day. And if it's Wednesday, Thursday, or any day, we'll do a little audience Q&A. And I think we already have one in the queue on Williams-Sonoma, but we'll get to that. With that said, if not for, I think everybody is laser focused on NVIDIA today, and maybe they're right to do that. Meanwhile, we have the Dow, and I know, listen, I'm not a big Dow person, neither are you, but you have this S&P is unchanged. You have the NASDAQ up 0.5%, and you have the Dow down 1%. I don't remember the last time we've seen sort of a day like this, Dubs.
Yeah, I mean, it's a weekday in general. Just one of the most basic and quick snapshots at any given moment in time is how many stocks that are currently trading are up versus down. The advanced decline is heavily skewed to the decline side. In the S&P 500, I think 300 plus names are down, 300, almost 400. So it's a 4-to-1 down day. And obviously NVIDIA, being the big heavyweight, is keeping the SPX unch, if you will, among other things. It is a sloppy day in general.
Well, it's interesting. I think, again, it shows the importance of, and you have a graph that illustrates this, but it shows the importance in terms of the market, how much an individual stock can sort of skew things. Because by itself, you just said it, NVIDIA is basically keeping the S&P unched and the NASDAQ higher in the face of what is a pretty weak day under the surface. Anyway, let's take a look at NVIDIA, because why not? You obviously have this gap higher. These are our charts. You're going to have probably a 2 times normal volume day today. I don't think, again, it means all that much. By the way, I want to point out that you were one of the people, was not me, by the way. You were one of the people that thought NVIDIA would sort of break out to the upside. You said that trend will continue, and typically that's how these things resolve itself. So here we are. You have analysts tripping over themselves to raise their price target. You also were correct. My concerns about that Friday, March 8th engulfing pattern, which were validated, as we got into the early part of April, but were then somewhat thwarted over the next couple of weeks. You said that probably didn't hold as much weight. That was correct. But here we are in the here and now. Thoughts on this?
Right. So it's a breakout, right? Everyone can see it. Their eyes are working. Otherwise, a trip to the ophthalmologist is probably in order. And after a breakout, hard to know. In many ways, coping with winners is much more difficult than coping with losers, right? Because we all know, hard as it is, to just cut you're supposed to water your flowers, cut your weeds, so to speak. So if you're wrong, it's usually better to take your medicine, walk away, at least reduce. When you're right, I mean, let's say we think, okay, it's broken out, I don't think it's got a lot more in it, and we sell it. And then it goes a lot higher. That's really a tragedy to have been present at creation, here for the breakout, catching the breakout and selling it only to see it go higher and higher, an unfortunate misstep. Conversely, what if we say, you know what, this is going to go a lot higher, we got to stay. And then all of a sudden it starts fading, fills the gap to the downside. What a disaster. We had all this profit and we just let it evaporate. There is no good answer. And so trimming on the increment is what people do. This is where you sell calls. A lot of premium pumped into the calls now. The 11.25s, way higher than where the stock is, are going for $20 and $30, that kind of thing. That's what I would do. Sell calls against your long.
The market is rewarding you to do that. I mean, obviously, the concern by doing that would be you'd miss. You give away we call it in our world the blue sky, right? You give away the upside, but you're getting paid in a certain amount to do that. So, again, I haven't looked at it. You clearly have, but if you're getting paid $20 ish to sell 11.25 calls, effectively, you're saying you'd be willing to give the stock up at 11.50. I'm rounding up by $5.
Right, and that's a lot higher. You're exactly
There
right.
you
Now,
go.
the 1120 calls are going for $24.35. So think about that. I mean, and that's only out till June. It's 18 days from now. So the time frame is right where either would one be willing to sell the stock at essentially 11.50? It's trading 100 points higher. I think so.
Mhm.
Or best case of all, you get to keep it and you take in that premium, effectively
And you
lowering
earn
your
that
cost
premium.
basis. That's right.
That's right. And I think that's the thing to do. Now, there will people out there that will say, if we had done that, any time, any place along this timeline here and now, we would have been called away. And, that's true. It's not true. I think right now the call put skew seems to be back to where it was, obviously skewing to the upside. So, the market is rewarding you. If you own the stock, the market is rewarding, I believe, is rewarding you with that type of strategy. But look, we'll see. Again, big volume day today. We'll see how it closes. It's clearly bucking the trend of other things. So that's worth watching. The other thing worth watching is probably the semiconductor index, right? Because that, one leads to the other. And here we are. And I'll go on record as saying I'm one of the people, probably one of the few now, that think that SMH, and we're going to throw up a non-static chart, we'll throw up a real-time chart. You had these major double tops around 163. If you go back longer term, Amanda and or Jacob, if you could put up a real-time SMH chart, you sort of see what I'm looking at. So it's hard to do, but if you put horizontal lines across the October 2021 high and then the subsequent high in the summer of 2023, there you go. Boom. You'll see that those tops actually sort of held up. Now, forget about what's happened subsequent. If you look what happened in the month or 2 months after, you had a pretty dramatic sell-off. And, that double top was right. It held the moving average, it held the 150-day moving average effectively, and now we've bounced. I thought that we would trade down to those prior highs in the form of sort of 163 to 165. And I looked pretty smart in the middle of April when NVIDIA was coming unglued. Obviously, it didn't happen. Okay, there you go. So let's go back to our chart. I think you're probably going to say the same type of thing. This is now broken out. I mean, it makes sense as NVIDIA is a huge weighting of the SMH.
Yeah. The concept of a double top is more relevant when there's a bunch of duration between the points in time. This is a minor prior high and we're moving above it. Whereas when we got to the prior longer term former high, we really got stuck at it. But look, it's NVIDIA that's causing this to gap up today and to move to a slight new high. And here too, with this particular instrument, I would be long but sell calls.
Makes sense. And let's take a quick look at Micron, because again, we talked about sort of that halo effect. Well, Micron's feeling it as well. And again, that's our static chart. We can do a longer term chart and you sort of get a perspective as to sort of the highs, the moves up and down in Micron, because, it's actually rather volatile stock at times in its history. And I think this chart will illustrate that. I mean, you've seen obviously big moves to the upside, subsequent drawdowns. Here we are now. Now, this move is somewhat unparalleled in terms of its history. And we're sort of in uncharted waters here. Again, moving averages are working for you. Those moving averages effectively worked as a pretty good uptrend line for the better part of 2023, obviously until we've seen this breakout the majority of this year. So is there a back and fill back down to the moving average, or is this thing that's continued to be autopilot?
Yeah, I mean, the key here is the breakout from those well-defined intermediate highs and 52-week highs, and then the follow through, the give back and back to the level from which it sold off in early March. It's kind of a pair of twos. I mean, there's nothing wrong with it here, but there's nothing immediate about this that says we should try to put capital to work to short it or to get long.
The one, I think the key to today is, and this is just through my lens and in my interpretation, is what's going on in the bond market. And let's throw up the sort of the TLT, the 20-year treasuries. We talked about this downtrend line being intact. You've brought this up as well. We've drawn this line, whether it's a good line or not. I mean, as you say, the sort of lines draw themselves, but the TLT has been in a downtrend the better part of this year. Obviously, that means as this goes lower, yields go higher. But along the way, as this has basically bounced, you've seen yields back off. Now, the question is that I sort of posed to you, and I know you're in the lower yield camp, which means you think we're going to break out to the upside here in the TLT. Does this have any bearing whatsoever? And am I making too much out of this one day move in treasuries with, I think now, 10-year yields, if I'm not mistaken, I want to say they're about 4.46, but I might be off by a little bit. I'll take a look.
Back up at I guess it's this one could say, rates are up so much over the past 2, 3, 4 years since the COVID low. All of this is true. But at the end of the day, if we were really going higher with, the spike in commodities and all of the pressure on rents that you see and all of the data, and why is the cost of 10-year money at 4.4, 4.5%? That is not high. It is just not high. It's benign. And so I think the message is that it's just that, and maybe a benign rate environment, whether one calls it Goldilocks or not, and that it's not but my bias over time is that rates will work lower, and we shall see. But I think it's this higher for longer thing. What's higher? I mean, if we have a yields chart, yields are the same level as they were at the end of if we do a 3-year chart at Q3 2022, they were at 4.4, and here we are at 4.4. That's 20 months later. Higher for longer has just not been a reality.
No, I think that's a fair. Listen, the point you make is accurate without question. It's, again, a lot of what plays into this is perception around yields and the importance of them. But as you point out correctly, that, if you just go back and look, we've been here before and we've withstood this. So, we'll see. It's 4.48, I guess. I just took a quick look, which, we'll see how this plays out. My concern all along has been a slowing economy, which we saw in the form of the GDP print, with persistent inflation, which we saw embedded in that GDP print a couple weeks ago, and then the subsequent CPI and PPI numbers, which, as much as people say they're working in the favor of the Federal Reserve, they're still stubbornly, persistently high. So we'll see how it plays out. You throw on top of that, obviously, what's going on with China, and to a certain extent, Japan, which I think is a bit of a powder keg. And then one has to ask, as these treasury issuances come out, people will buy our debt. The question is at what level? So there's a supply-demand aspect to this as well. And that's what makes markets. You can look at through technicals, fundamentals, marry the two, try to figure it out. But as the market wants to do, it'll always, at least for me, it humbles the shit out of you.
Yeah, and just if one didn't know what this was, again, it was a commodity or it was a stock, we would say, wow, this was a real loser that finally turned and bottomed, bearish to bullish reversal, and has an epic run. But is it stalling and churning now? Does it have a little bit of the look of a fade? And that's the risk here. Not that it really goes a lot higher. That it is, if it were a stock having gone from 1 to 5, as you see there, that happens to be yields. And is it losing its luster? That's how I interpret it.
And I think that's fair. You brought, this is a timely, your work is always timely, but more so today because the next couple graphs and charts speaks to weightings and what's going on. So let's walk through this because, as much as we say, or much as you hear people say the rally is broadening out, in reality, it's really not. So let's walk through this.
So I thought, today maybe focus on the financial sector really specifically. So obviously the second biggest weighting of the 11 sectors, but really the most important in the sense that the banks and the big financials are the transmission mechanism for the economy. It's where leverage is, it's where lending is, and in many ways the most dangerous. It's anytime there's been a crisis at a company, it's because of debt. Companies got a business, you borrow too much. This is where the rubber hits the road. The big institutions, the whole phrase of too big to fail, right? That kind of thing. But anyway, we know 11 sectors. This one, has almost a 13% weight. If we look at the sector itself, I think we have here, just to put it in context, it's 71 stocks. The top 15 there, you see them there, 65% weight. Berkshire, in many ways, of course, one could say, well, is it a financial? It's so many things. It's candy and it's railroads, but obviously insurance is the big game there. And one could say, well, that's the safest of all. And you're damn right it is. The rest of them are what they are. Visa and MasterCard are safe until one day the regular laws change, right? Or JP Morgan is safe until one day you have a financial crisis. But you see the names: Bank of America, Wells Fargo, Goldman, American Express, Morgan Stanley, all the big names, big insurers like Progressive and Chubb. So let's drill down a little bit more and try to look at this in several different ways. I think we've got some charts just to show you. So two lines, sort of autumnal colors there, even though we're in the spring. But you have the SPY in orange, and you've got the XLF, the financial sector. Now, there's autocorrelation here, right? The brown line is a constituent within the orange line. But either way, two lines, comparative charts, and we see here how poorly financials have done over the past 5 years. Let's do 10 years. Again, financials not doing as well. Let's do 20 years. And this is the real issue.
That's the real issue.
The 20 years, you're upset, you're compounding it. And here's even more. So you're compounding at a rate that's below inflation. There's no gain. Now, these are comparative charts. If you do it as a ratio or relative chart, this is the real tragedy. The financial sector's relative performance is basically where it was at the 2009 financial crisis low, when Lehman and Bear Stearns and the end of the world was at hand. It has not been a good investment. It has not been. That doesn't mean that they're all that way. Progressive is one of the best performing financials and stocks in the world. But as an aggregation, the dilution associated with things like AIG and Citibank, which increased their share count 20 and 30 fold, that's that plunge in 07, 08, and 09. It's dead on arrival. And here we are this many years later, and it still looks like this. It's generally a bad business.
Yeah, listen, I think what it speaks to is since the financial crisis, there's been a reticence. The economy's changed, I guess. Maybe banks were a vital part, and I shouldn't use. They're still a vital part of the economy without question. But in terms of the magnitude, the importance to the broader market, clearly not so much anymore. And I think there's been a concern in the investment community about being too deep into some of the financials, as opposed to this changing economy we've seen in the form of technology. So we'll see how long that continues. But you look at that chart up right there. I mean, that is stark if you really think about it in terms of what's going on. So I guess you can make a couple of points. So you could say, listen, we're going to hold here, and we're going to start to see, some sort of a rotation out of things into financials, or this is just going to continue to sort of this descent.
Right. Now, this is something that has to be sort of considered too. It's they're not regulated, right? They're not like utilities, allowed rates of return, but they're regulated now because of the big screw up they pulled in 07, 08. So it gets down to Sandy Weil, of course, and they eliminated Glass-Steagall, and they allowed big insurance companies and banks and brokers to all merge, which they said was very bad in 1929. That's why we're not going to do that. And as soon as they do that, boom, 07, 08, 09, financial crisis. And now the government said, okay, we got fooled. We let you take off the rules that we've had in effect since 1929. And now you guys are in the doghouse forever. So they're constantly monitored, their capital ratios, all the things. So they will never have the ROEs ever that they had in 03, 04, 05, because they're not going to be able to have the leverage required to get those rates of return.
Without question. Yet, and before we get to your XLF chart, you're 100% right. Now let's put up a JP Morgan chart, and we looked at this. You and I looked at this the other day, and we talked about the comments that Jamie Dimon made. But if you look at a JP Morgan chart, if you didn't know this was a bank over the last year or so, you'd be like, huh, that's pretty interesting. Maybe this is a healthcare stock that just sort of ran into a source, a new drug, right? A new indication. Maybe this is a technology company that's getting on the back of AI, because the move we've seen since basically November of last year has been like. So, as much as these have become utilities, for some banks, the market is rewarding them in different ways. I only mention that because it was Jamie Dimon himself who said the other day that, hey, we're not buying, and I'm paraphrasing, we're not buying stock back here. The stock is expensive. So I think you make a really good point. And sometimes the market, again, wants to believe things that maybe the fundamentals suggest otherwise.
Yeah, and obviously, even as Jamie Dimon has, makes judgments on the market, I think he thinks to some extent, banks are full. Now, there's a big asterisk. Remember when he bought aggressively near the lows and the stock jumped because, wow, Jamie Dimon's coming. Can never do the opposite. Think the news hits the tape. Jamie Dimon selling shares. He's going to have to take this to the grave, right? Because if you start doing that, you will, people like, oh, the JP Morgan, literally of our era, the greatest bank of all time, selling his own stock, of which he's one of the biggest holders. So, he's in. There's kind of no way around that. In any event, yes, a very good chart pattern, but here too, a bit extended, a bit too far above trend.
No doubt.
Moved a long way off the October low. At a minimum, sell calls or some other measure to reduce exposure.
And to sort of, before we move on, and I'm sorry about this, but real quick, if you could go back like a 10-year chart of JP Morgan, Jacob or Amanda, and it was a Friday. I don't have the exact date in front of me, but it was a Friday in 2016 in February. The market was on its ass, without question. The S&P was getting throttled. JP Morgan was trading about $54 a share-ish. And I remember like it was yesterday, there was an announcement that Jamie Dimon was personally buying JP Morgan stock. And that, in collaboration with some news out of OPEC and a Deutsche Bank bond offering all on the same day, basically put a bottom in for the S&P, and we've never looked back. I'm not suggesting Jamie Dimon, but you understand what I'm saying. So that announcement was obviously market moving. And my point is, if the market paid attention to him then the way it certainly did, I think the same should hold true now. The difference, of course, being is people are biased to the bull side. So when they hear bullish things, they're going to want to jump on. But when they hear things that are counter or not, doesn't basically line up with their own narrative, they don't want to hear it. They want to dismiss it.
Totally. And in fact, we were on the desk that night. It came in after the close.
Yeah.
Diamond buying. I remember.
So you do remember. So I'm not completely out of my mind, which.
No, it was, and Melissa, we led a conversation about it. In any event, yeah. So financials overall, not a great area. There's always winners within. Maybe for fun, this chart, and put up progressive PGR. Let's just do this. This is the greatest performer of any financial, and do maybe a 10-year chart. Now look at this. This blows away. Remember, the JP Morgan chart was going from 50 to 200. This is 20 to 200. This is a 10-bagger. And if you went back further, it's shocking. This is one of the best performing equities, bar none. So there are always good and bad players within a space, and Berkshire being one of them. But the insurance stocks in general, and this is a testament to it, have been tremendous.
Yeah, I mean, Chubb's going to look similar without question. Let's take a look at your XLF chart and some of the things that you brought. And I'm sorry to get off a bit of a tangent there, but you brought some other charts. So let's walk through.
So we looked at the comparative, right? The orange and brown. We looked at the relative. Let's do it a different way. This is the absolute XLF chart, and we're back to the former highs of late 2021. But if you do this as a two-panel, let's just do it, the next chart. So this former high, the question is, do we get up and out of there? But look at this, and then look at a two-panel we might have. So it's the same chart. Now, this is the problem. It's back to relative. So all through 20, off of the COVID low, all through 20 and 21, the XLF is going up. But its relative performance to the S&P is a donut. And then this past 2023 to 24, XLF is going up and it's going down. There's just no alpha here. And that's what it's all about. One can say, yeah, but I made money in XLF. Okay, that's fine if one made money, but it's no different if you're sitting in the backyard at the barbecue in the .com era in 1998, and you said, I'm up 30% this year. And the other guy says, I'm up 150. I'm up 200. You're up 30? That's great, but that sucks. So relative performance is what alpha is all about. There just isn't any in the financial sector.
Let's take it. I think, and you brought some stuff. So if you look, I mean, relative the S&P without question, but you have a Goldman Sachs chart as well that I think is interesting here, because this trough to peak, I should say, has been staggering.
JP Morgan's the same. So many of the winners, This is excessive, too far above the 150-day. So I think you can annotate it with a red arrow, and you'll see that. And that's a judgment, of course. Someone could say it's going to go a lot higher, but take a look at this next longer-term chart. So that's going back to the peak, the 2007 peak. You got the financial crisis low. Let's put in the trend line. I don't know. I think buy, sell, hold. I wonder what we could look it up here. Let's just, for fun, let's see what.
Well, that's 16-year chart right there. So
Wall Street has a price target. You'd love this, of $456.
Where is it trading?
461.
Right.
So it's covered by 25 analysts who collectively have a conclusion that the stock in the next 12 months has a target that's below where it's trading now. That's on the fundamental side. On the technical side, it's come back to a very difficult level. On the shorter term chart, if we went back, it's trading far above the 150-day moving average. I think you sell calls, or you trim, or you take some measures here and now.
Makes sense. And the next one, American Express, this is one that's really, I shouldn't say that. It's defied my logic, because I thought as credit concerns started to grow, the stock that would be most vulnerable would be American Express. Clearly, that's not what happened since basically the fall of last year. And I think in no small part being, you can overlay a move in interest rates when, I think at its trough there, American Express at the bottom of that 73.45, that was probably the peak of 10-year yields. And then obviously things sort of turned. So as yields went down, American Express went up. I don't think that's coincidental.
Exactly. And just to put this in context, I'm just looking at just if anyone's interested in the little fundamentals, at that low in October, American Express PE was 13. It's now 20, meaning stocks moves up, but it's more expensive now. That's the point. Far above the 150-day. I think this deserves a red arrow. Let's put it in and take a look at the longer term circumstance as well. And let's put that trend line in. It's just like the Goldman. Okay. Big move, yes, come a long way, or what? Maybe should we double it, get more long American Express and Goldman? I just don't think that's good technique. So do nothing. That's one thing. Trim a little, trim a lot, but buying more doesn't seem like a good play here.
It's interesting as we're sitting here, and again, I don't make a big deal out of a day where the S&P is down 6 handles, because it's not a big deal, obviously, but this is one of those below, and you led the show with this. This is one of those below the surface type of days where the majority of stocks are getting throttled. I mean, the Dow's now down 1%, which we haven't seen, I don't know the last time. I mean, I'm sure it was recently, but the NASDAQ's up 0.4%. Russell's down about 1%. Just so many moving parts here, and then you throw on top of that, Carter, a VIX that's actually slightly lower today, and still with the low 12 handle. Again, so many, and maybe that has something to do with the holiday. I don't know. I haven't been able to figure out the volatility index for a while, and I think, quite frankly, it's a much different instrument than it probably was, 5 or so years ago. But with all that said, it's a really strange frickin' day underway here.
Yeah, a lot of dispersion, as you will, but 4-1 decline to advance. Sloppy day.
All right, some questions I promised. It's Kevin Mendoza's asking, thoughts on Boeing, some negative free cash flow. So for you folks that don't know, here's the story that came out. I think their CFO was out. Boeing's confirming early reports its delivery to China are delayed because of a regulatory review of the batteries. The CFO said there will not be an increase in Q2 commercial jet deliveries compared to the first quarter. But I think this is a headline that sort of stuck out. Second quarter cash flow may be worse than the first quarter, and they expect negative free cash flow in 2024. And that was prior low single digits guidance given in March. So let's throw up a Boeing chart real quick. Amanda, there you go. So obviously the stock didn't like that, which makes sense. I don't know. I don't really know. Kevin, I don't know what to make of Boeing here. I thought incorrectly that when they announced that the CEO was stepping down, and that was, I want to say, when was that, Carter? Like in January, mid-January, or I don't even remember. It doesn't matter. Or no, you know what? My bad. It was in like March, and the stock went back to 196. And I'm like, okay, that's it, finally. But no, I mean, here we are now. So I don't know what to tell you. I mean, I look at this and say, we've gotten through all prior levels. If you do a longer term chart, you're going to try to find support.
We're basically at just a
I
slight
don't
bit
know what
above
I
the
don't know what
COVID
to
low.
say. Yeah.
Yeah, there's the COVID low. It's messy. I mean, again, here, what about this? Because the seduction is, oh, it's Boeing. Boeing will always be around, which is true. There's only one. There's only a certain number of people who can pull off the very hard feat of putting a real aircraft in the air, and that no one's going to start a new. There's not going to be the Guy and Carter new airplane making company. And so Boeing, you've got to buy it when everyone hates it and be contrarian. But there's just no urgency to do that now. Why? It's clearly got problems. Stay away.
DraftKings is a question we have from, I want to say, Jeff H. And the question is thoughts on DraftKings. If you watch Fast Money, we've liked this name for a while. When I say for a while, most of 2023 into this year, it's been lower left, upper right. Obviously, it's been giving a little bit back. I think it's down about 4.5% or so today. This is just me. I wouldn't run too far from it. We've seen pullbacks along the way. I still think the uptrend from basically late December in 2022 is in place. I don't think we violated that. I mean, you can see it. You could probably draw that trend line if you want to, Amanda. It's from, if you want to go from January of 2023 or so, the moving average is effectively your trend line. I mean, Carter talks about this all the time, but there you go. Any quick thoughts on this one?
Yeah, buy the dip.
Yeah.
Down to support.
I'm with you. I think you still got to play it from the long side until that's violated. I understand why today's sort of messy day, but until you sort of close, I think below sort of 38.5 or 38, you still have a series of higher highs and higher lows. And I think that's going to stay in place. This is a good one for you. And there's a lot here. From Chris E. Hey, guys, a lot of pain under the index on stocks like Ulta, Lulu, McDonald's, Disney, Shopify, blah, 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 blah. Yeah, there is a lot of pain. The first one I want to take a look at real quick is Lululemon because, specialty retail, Jeff Mackey used to come on the show, and I know, Carter, Jeff very well.
Mm-hmm.
He used to say that specialty retail is where hope goes to die. And his point there was, on the way up, it looks like nobody's ever going to be able to take the place of these specialty retailers, and history is littered with a lot of them. The last major one was probably like an Under Armour or stuff, and then something magical happens where, to a certain extent, competition comes in, their margins start to contract. You no longer have the growth, and then things go pear-shaped really quick. If we could do a longer-term Lululemon chart, you'll see that growth trajectory was in place for quite some time, and it's sort of when it stops, it friggin' stops on a dime, and that's when things get really dicey. We had an analyst on the other day on Fast Money, I want to say it was Tuesday night, who has a $240 price target on this name, and he actually thinks a worst case scenario is like $150 stock. So I'm not going to disagree with him because when you start to decline in terms of margins and when your growth rates decline, that's not a particularly healthy mix. And nobody can like this chart, especially now with the moving averages working the wrong way.
Yeah, I think that's a Jeffrey's answer, right? He's saying this is the next Under Armour, which, of course,
yeah,
the long-term chart of Under Armour, pull that up for 10 years, it's just been an absolute disaster. So is Lulu on its way to being a recognized brand that's then gone? I mean, look at this. This is 4:45 to 5. Hard to look that far out in the future. Bold kind of call, but a little bit more sensationalism than anything else, I would say, because talking about the demise of a brand really before it has happened. But to your point, more importantly, when a growth stock stops growing, the most precipitous drops occur because people re-rate in a permanent way their future assumptions, and therefore the multiple really contracts.
Well, it's hard to get that growth back is what it really comes down to. I mean, the only company that I can think of off the top of my head, and this is not a retailer, but the Netflix, for example, which sort of saw, a bit of a trough, and you're like, holy shit, that's the end of the Netflix story. And the stock acted in kind only then to sort of reaccelerate. So that's a decent example, I guess. It's an example, but
Within
we'll see.
consumer, it's one we looked at just earlier the week, you and I, Abercrombie, A&F, right? So it's left for dead and then it recovers. And this is one of the great recoveries of all time. But now, again, it's all about cycles. It was, left for dead. And then all of a sudden, at the COVID low, if we pulled that up, you see it there. It was $5, $6. So they do recover. A Williams-Sonoma, think about this selling spatula.
Well, that's, you know what? Thank you for doing that, because we have a question from somebody with a lot of letters in his or her name, and please comment on Williams-Sonoma. And this has been another monster. Now, you've had some really odd price action recently, but man, oh man.
Yeah, I mean, so today is a wild day, which you can see, and so a huge sort of open and then fade. So there must have been news, but I would sell my Williams-Sonoma.
Yeah, so I don't know if you have volume in front of you or not, Carter, but you had
4 million, big day.
We'll see how this thing plays out the rest of the day, because I think the average volume in this stock is about 1 million shares or so a day. So we're on pace to probably do 8 to 10 times normal volume. So keep a close eye on this one as well. We covered a lot. I don't see any more questions, Amanda, unless I'm missing. Oh, Moderna, we got a question from Scott A. Before you even look at it, I'll tell you right now, this is a friggin' pair of twos at best. If I don't see anything compelling. I think it's making a 52-week high today, but you're right back to levels that we probably touched. We've been going sideways now for the better part of 2.5 years or so. As you get towards the 170s, it's going to be major resistance, I think.
Yeah, it's a bearish to bullish reversal that's now played out. So if we look at the short-term chart, it's chasing here. And I know there's some news about bird flu and all this other stuff, but the turn is epic, but it's already turned. You're up considerably off the low. The bearish to bullish reversal, there it is. And now this is the kind of thing where if one's been paid, you start harvesting, you take some profits.
Carter Worth, you remain the man. I always appreciate your time. You got the Engelbert Humperdinck look going. You're ready for the Memorial Day weekend. No shave. It's all working. Monday, holiday. Tuesday, Dan will be back for Market Call. But throw this up, Amanda, because we got some cool shit going on. Check out the Market Matrix. And today's Thursday. So today will be day 4 of the Market Matrix. We dropped it yesterday right after NVIDIA reported, but typically right after the close, you will see this. There's no reason not to sign up for it. And if you want the trades, you can check out the inbox. Throw that slide up. I mean, if you want your trades, you get them in your inbox. Why wouldn't you? There you go. See that? Sign up today and leave reviews. I mean, we have some giveaways going on. Look at this. Man, oh, man. Right on it. Leave a 5-star review, hopefully. I mean, we shouldn't tell Amanda. We really shouldn't tell people what review to leave. Just asking them. But fair enough. Leave a 5-star review. Screenshot that. Email it to contact@riskreversal.com. Send your size in and your mailing address, and we'll send you a T-shirt. You look badass. I mean, why wouldn't you do that?
It's a good-looking T-shirt.
And I think that's it, Amanda. Oh, no. Where are we on social media? Throw that one up. We're all over the friggin' place. And throw this one up. If you want Carter Braxton's Worth, we have that slide too. Put the Carter slide up, because this is great. It's a great picture of you. Look at that.
There we go.
Worth charting. Old-fashioned technical analysis. Nothing slick, just charts. CBW. You're the man. Enjoy your holiday weekend. I think the Yankees are winning right now. The Mets continue to suck. Ranger hockey tomorrow. We'll talk to you next week, folks.
All right. Bye.